Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
After the bell today, Netflix posted its best start to the year since 2020. Netflix adding 9.33 million customers in the first quarter of 2024. That's nearly double the average estimate from analysts. Despite that, Netflix shares were down about 5% in late trading. The streamer reported a weaker than expected second quarter revenue forecast. Joining us now for some discussion of this is Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst, to take a closer look. So, Geetha, Netflix, well, pretty strong rebound, I think you have to say, albeit with a few qualifications. On balance, how do you read these results?
Very, very strong results, without a doubt. We're seeing really good momentum when it comes to the subscribers. And the big story, of course, for Netflix is that they are trying to balance subscriber growth along with their financial metrics. So the most important metrics here being, revenue growth. And they were guiding to, or they were targeting rather, double-digit revenue gains, which they delivered and will continue to deliver through the rest of the year. And then, of course, is profitability. They're one of the only streamers right now to have very, very strong profitability metrics. They actually upped their guidance when it came to operating margins. So on balance, a very, very strong report card, although you did point out the slightly muted outlook, which is why we're seeing the share reaction.
Geetha, I'm trying to understand whether or not this growth is being powered by original programming or crackdown on password sharing. Which is it?
So it really is, I think, the biggest driver of this subscriber momentum that we're seeing is really the password sharing initiative. Netflix had initially identified about 100 million global households that were not paying for the service. And we know that they've cracked down on password sharing across all of their global markets. So this is really the biggest driver. They haven't exactly outlined how much they've captured or how much is left. But just kind of given the guidance and the fact that they alluded to, much slower subscriber growth in the second half of 2024 versus the first half suggests to us that, the positive tailwinds from this password sharing crackdown will start to fade pretty soon.
Now, Netflix shares were up 71% since October. So to be fair, a 5% pullback is probably not very likely an indictment. It was a good quarter, and you said that. But it's important to talk about the qualifications, too. And Doug raised one, perhaps. Another might be that the company is going to stop reporting the number of subscribers. Now, that would raise a few questions among some. What do you see as the reasons for that? Or what are you hearing?
Yeah, so I think what they said is that there really are so many moving parts to this story, right? In the early days of growth, it was really just a very, very kind of a plain vanilla story. You had more subscribers, you charged them whatever amount you were charging them, and you kind of had this whole growth model. It's kind of become much more nuanced right now because we're kind of reaching this very mature stage in the Netflix narrative, and they have a lot of growth levers, right? Advertising is a huge lever that is going to kind of start ramping up. They're probably going to start introducing new plans at different price points in different countries. And so it's kind of becoming harder and harder for them to parse out everything. And I think that is one of the reasons why they are suggesting that they don't want to be tied down to the subscriber metric, because we know that every time Netflix reports, the subscriber numbers, there is just so much volatility and so much noise surrounding that one number. Now, the lack of that number is also creating a lot of noise.
So if you look at markets outside the U.S. and Canada, away from North America, how is this company performing right now globally? Where is the strength coming from?
The strength is really broad-based. I mean, we know that the U.S. and Canada is a mature market. It's almost, 70, 75% penetrated. That said, if you looked at the first quarter numbers, this was one of the strongest subscriber gains in the U.S. and Canadian markets. But growth is coming from other markets as well. If you look outside of the U.S., Europe tends to be a very, very strong market, continues to perform very well. So is Asia Pacific, which is a relatively under-penetrated market. And so there's obviously a lot of optimism for a growth upside in many, many years to come.
Yeah. Well, I'm curious in terms of revenue drivers, how's the ad tier doing?
So the ad tier, they haven't really given us a lot of color here other than to say that they are building the infrastructure for this business. They do have, programming which will kind of serve that ad business well. And when I talk about the programming catering specifically to the ad business, it's really live sports. They have a deal for WWE content starting in, 2025. They're also kind of dipping their toes a little bit with live events. So they have this big boxing match between Mike Tyson and Jake Paul, which is coming up in July. And that kind of allows them to test, the appetite, the market for live sports. And we think they will become a bigger player in the live sports market. That actually helps them scale their advertising ambitions, I think, pretty significantly. And what we are kind of projecting at Bloomberg Intelligence is that advertising will be roughly 10 to 15% of their business. This is a $45 billion business in 2025, the total business that is. And we think advertising will be about 10 to 15% of that.
Geetha, what do we know about what Netflix intends to spend on new content going forward? Do they have the pockets to continue driving on the content side?
Oh, they absolutely do. So they've taken actually a pretty disciplined approach. So for this year, they reaffirmed their content budget of about $17 billion. Going forward, we think it'll go up by about 10 to 15%. It probably will reach about $20 billion or so in the next 2 years' time. But again, that's well within the range. And they are definitely taking a very disciplined approach, again, not just with their original content, but also they're going in more for licensed content, which tends to be much more effective and economical.
So we see that Netflix is number one. I think Amazon Prime is number two, right? How are we shaking out when we look at all of the big streamers?
Netflix clearly wins, not just in terms of subscriber numbers. So obviously, they have 270 million subscribers. They are the biggest streaming service across the world. But then again, it's not just that. It's also, engagement. And that is the one key metric that they kept on talking about over and over again in, the earnings call in their earnings newsletter today, because they do have they said they have roughly 500 million people across the globe tuning in every night into Netflix about 2.5 hours. And so as they have that engagement, that kind of then speaks to so much more monetization capabilities, right? So they can increase prices. They have a captive audience that they can sell to advertisers. So really kind of improves the growth outlook for the company on so many different fronts.
Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst. Joining us in our studios is Herald van der Linde, who's head of Asia-Pacific Equity Strategy at HSBC. Perhaps a big sell-off is underway. We've got higher for longer on rates, investors setting the bar pretty high, and a strong dollar. Do you see it that way, or do you see things as maybe more like half full?
No, I think you're nailing you're hitting the nail on the head. We've gone from a scenario whereby in the beginning of the year we were talking about maybe 4, 5, 6, 7. I think even at one point in time people said 7 rate cuts. Now, what we then saw was inflation was coming down. It flattened out, and now it's actually ticking up a little bit. And the market is really reshifting that, right? So it's saying there might be no rate cut at all, and some people are talking about rate hike. Now that changes the macro environment for Asian equities completely, right? So we have a stronger dollar, we have higher bond yields, and all of these things, and that just doesn't help Asian equities. So yeah, that's where that pressure is coming from.
But if I look at the fact that this is maybe an illustration of very strong American growth, demand may still be a part of the story. And if you're an exporter anywhere in the APAC region, the outlook for business is going to be pretty good, is it not?
Yeah, I mean, that's the nice thing of equities, right? There's always something somewhere happening. So, yeah, you're right, exporters. But if you look at the totality of Asia, or, for example, at the Chinese market, the vast majority of companies are domestic-oriented companies. So they will not be impacted so much by the stronger U.S. They just have to deal with the domestic issues. But the ones that are exporters, and most of the Asian exporters are really in Korea, Japan, and Taiwan, they benefit on the demand side and on the currency side, because their currencies are getting weaker, and insofar they produce something in Korea, Japan, or Taiwan, it means that they have a little bit of currency tailwinds as well. So that helps.
And we're getting jerked around a little bit with some of the data. Like I was having a look at the Philadelphia Fed Factory Index. It topped estimates. In fact, in a very big way. The index all the way up at 15.5. The survey at only 2. But then prices paid were at 23 versus 3.7 before. So, I mean, how do you actually digest this kind of data and make sense of it?
There's a lot of data coming at us. But I think the overriding picture is simply of just unexpected, incredible strength in the U.S. economy.
And that leads to higher prices.
That leads to higher prices and these sort of things. Then, in addition to that, you have oil prices potentially being a bit volatile. The Middle East has got all sorts of issues there. So that could lead to oil prices. So all of these things could fuel into higher prices. Now, if you can also find good reasons to believe that actually these inflation numbers will come off again and these sort of things. So we'll have to see how it goes. But that means that the market is just very uncertain on what the path of inflation is and therefore what the path of interest rates is. And that creates that volatility in the stock markets.
One of the things that I'm noting now is that Japanese inflation for the month of March came in at a monthly reading of 2.7%. That was a little bit below the consensus. I think the street was looking at 2.8, but we know the Japanese currency has been under pressure, still trading around a 34-year low against the greenback. What choices do policymakers in Japan have, whether it's the Ministry of Finance considering intervention in the foreign exchange or the BOJ?
Yeah, this is difficult for them because the currency has been very, very weak. And now we have there's this meeting in the IMF, so maybe something will be discussed there. Who knows? But yeah, the currencies are weak, and we've now seen also when Yellen was around that the Koreans and the Japanese have publicly stated that they feel somewhat uncomfortable with that currency weakness. What can they do? The ultimate problem, simply is that they have an interest rate policy that is still close to zero. Now you might say, yeah, they've increased it a little bit. But we're talking about minuscule changes. So interest rates in Japan remain very, very low. And insofar the US is strong and interest rates remain high, that means that you have a massive interest rate differential. And you see this with Japanese households. They're taking their money out of Japan and putting it into the US because that's where they get 5% on a deposit or something like that. In Japan, you get nothing.
Some Japanese companies are benefiting from China growth, but it's not easy to estimate China growth. We put a piece out on the terminal today that Bloomberg calculations suggest that China will contribute more to global growth in the next 5 years than all the G7 combined. It's a staggering number. It's like 21% versus 20%. Yeah. Now, we know that in the short term, China's kind of gearing up for the May Day holiday, and there could be a lot of spending. How do you see China moving here in the short term?
Yeah. Now, so when the GDP numbers came out at the beginning of the year, a lot of people said, around 5%? I thought it would be much weaker. I even had people say, I can't believe that particular number. Now, we now have more data, macro data coming out of China that supports that actually the economy is chugging along reasonably, a bit faster than what the market was forecasting. But we also look at earnings. Now, you can say, well, earnings, accountants can fiddle around with that, but cash earnings, what we call cash flow, money that you flow in and out of your business, there's nothing to fiddle there. And actually, it's not too bad. The earnings growth has held up reasonably well. We've got earnings growth of about 15%, cash earnings about 8-9%. That's probably in line with the macro numbers that we get. So there is growth in China, and it's probably a little bit better than what people would have thought it would be 3 or 6 months ago.
Herald, thanks so much for coming into our studios and sharing your insights with us. Herald van der Linde, head of Asia Pacific Equity Strategy at HSBC. Our guest is David Finnerty, Bloomberg FX and rate strategist. Take a closer look at markets. So the mood has changed quite a lot here over the past couple of weeks, David. We talked about higher for longer rates there in some of those comments from leading Fed proponents. And also the bar seems to be pretty high now for earnings. We saw that with a lot of the after hours selling. And the dollar, ever stronger, is also kind of wreaking havoc on markets. Do you see that holding for a while, that kind of mood?
I think so, overall I'd say yes. I think the equity market, if you look at it now, so much good news was baked into it that I don't think it takes a lot of bad news to just give it a nudge down. The S&P ran from 4,200 up to 5,200, basically without much of a correction. So some sort of correction is quite standard. With US yields, I think the hawkishness is heavily baked in. I think to get more hawkish in the near term, it's all data dependent now. And you really need strong data. Now, having said that, we don't really have much data out next week until the US PCE. So without that, it's like, well, how do yields push higher? And you're actually pushing down slightly now because of Middle East tension. So if US yields don't push much higher, that does to some degree limit what the dollar can do. Having said that the dollar does benefit in a risk-off scenario. But overall, I think the moves we've seen have sort of been baked in. And I don't think, I think there's more risk to US yields pushing lower in the near term slightly, and a bit more risk-off sentiment in the near term.
So when you look at the price action today, this weakness that we were seeing in equity markets in the APAC, where is that money rotating? Is it moving into the U.S. Treasury market? Is it a haven bid that we're seeing now? I'm looking at crude up nearly 1.8%. The dollar is stronger. The yen showing a little bit of strength here, not by much. Do you have a sense of how this money is moving through the market right now as we see weaker equities in the APAC?
Yeah, it's tough to say. I mean, it fluctuates. Middle East, I was on the way here. I think I saw some potential headlines coming across from some of the team saying that something may be happening in Iran. And if that is the case, then obviously the market's very jittery when it comes to anything on the Middle East at the moment. So the safe haven flows is just where the money tends to go to very quickly. It's like, just go ask questions later if there's something going on in that area. And obviously oil's reacting to it as well. Now, obviously that could calm down once the dust has settled, but the knee-jerk reaction is always just go to the safe havens till we have a clearer picture of what's going on.
We talked about a number of factors that could be leading to risk-off sentiment. In some cases, it's way worse under the hood than it is with the headline number. For instance, the S&P down just 0.2%, but there was quite a little bit of selling attached to some key names that people are heavily exposed to. I wonder whether or not yields getting up on the 10-year up around 4.5% to 5%, whether 5% could be a real kind of inflection point, really sucking in a lot of money by asset allocators.
Yeah, I think five is a nice round number, so it could draw a lot of interest. I don't think necessarily 5% is the number, but I think, look, anything around this level, 4.7s to 5 or anything around that is certainly of interest to people. Of course, the catch is you come in, certainly if your funds in, you're trying to go long duration, you've been burnt so many times before that it's a bit like a broken record, and you're worried now, like, okay, particularly with this rhetoric coming out of the Fed, like, hey, we are considering a rate hike if needed, or that possibility is on the table if the data backs it up. Then, of course, should that happen, again, this is all lots of caveats, but the idea is then you will see yields go even higher. So I think the interesting thing becomes is you go, 4.7 is attractive, but you go, 5's attractive, and you get the 5 and you go, actually 5.2 is attractive. So it's a bit of a moving line in the sand, and I think it's really only when the market see that data flip and they're confident that the data's flipped, that the rate hikes are off the table and the rate cuts are back in, then I think the market will jump very quickly into treasuries.
We had comments from the Japanese finance minister Suzuki, who was talking about the interest rate gap, the differential between the U.S. and Japan, and that's really what's been weighing on the yen. Yeah, maybe there are a few other factors. Then we get this reading today on consumer inflation in Japan. Okay, excluding fresh food, we're up 2.6%. That's still above the BOJ's target, but it's below estimates. Is that in keeping with this idea that the Bank of Japan will continue to tighten, or are they kind of in a holding pattern right now, particularly when the data is not making a compelling case?
I think based off the rhetoric, now again, Bank of Japan has said one thing and done the other. So, but if you're based off the rhetoric, I think at the moment they are in the holding pattern. I mean, the consensus in the markets is if they're going to hike, it looks more like October or potentially September, which sort of makes sense. You're going to wait till all this wage data is fed through, which comes through in basically July, August. You get all the impacts on the labour cost earnings fully fed through, and then you obviously have the quarterly reports in later in that third quarter. So I think they'll wait till then. Obviously, look, next week, Bank of Japan and Gunny Away, there's going to be grilled on the exchange rate. I think there's going to be no shock on that. I don't think they'll do anything. But how he reacts to the exchange rate, people are going to be looking at that words of, well, would you consider a rate hike? And one of the governors said yesterday, said, look, that's not really what we should be using the exchange rate monetary policy for. But, they'll be looking to see what Ueda says in the comment and go from there.
So in terms of risk on and risk off, not being too specific about one market here or one market there, we do have the dollar and yields getting kind of close to, I guess, levels that, there might be some resistance to get to the other side of that. Is it also quite possible that if you got, all sort of bared up here, that you could get your face ripped off because the rally can come back at any time?
Oh, yeah, I think certainly with the dollar. I've been a big dollar bull the whole year, but even now, I just put a piece that will be going out shortly saying that I think the near-term upside's a bit limited for the dollar. And the reasons being is, yields have the market pricing is only pricing 38 basis points of cuts this year. That's not really that much, and you need a lot more data to back that up, which can happen, certainly, but you need time for that. And the other thing to factor is also the other sides of the FX equation, certainly on the euro, which is the biggest portion of the dollar index or the Bloomberg dollar index. Germany's economy is starting to turn the corner. That PMI data is starting to improve. And I think if that starts to happen, the market suddenly starts going, well, we were too aggressive on the Fed rate cuts this year. Are we too aggressive on the ECB rate cuts this year? Yes, June's going to be rate cut, but after that, the ECB is very vague. So suddenly you go, well, why should I go from 3 cuts down to 2? If you do, that's euro positive, dollar negative. So I do think the upside's it's a lot more harder for the dollar to rally in the near term. Having said that, as you alluded to, the downside is a bit limited because US yields aren't going to tank anytime soon. And if they really did, it would be because of big risk off, which is dollar positive anyway. So dollar upside is limited. I think a period of consolidation in the near term is what's going to happen. David, very quickly before we let you go, I want to get your thoughts on the Chinese currency. We haven't talked much about what's happening in China. We're 725.70 right now, offshore yuan. What's your outlook here? Well, I think obviously the fix has stayed around the 710 level. I thought they may go back in the 709 handle, but when the PBOC didn't do that, when it had the option earlier this week, then it did say, well, we can let it go weaker if we want it to. But again, they're going to let it go very, very gradually. They're in no hurry to have to get towards the 730 or above 730 anytime soon. So I think any weakness will be a grind, shall we say. All right, David, thank you for joining us. David Finnerty, Bloomberg FX and Rate Strategist.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.